This week, folks, wasn't short of any surprises. We saw negative GDP for the first time in 3 years. Gross domestic product sales, me and you transacting dollars for goods in the United States, went down for the first time in 3 years thanks to this new administration. You can thank Donald Trump, though he'll probably blame Joe Biden. However, we actually saw the most resilience out of tech companies, which came as quite a shock because on the back of recession fears, people typically run to consumer staples, stocks where they think there's not going to be any volatility. And some of those stocks saw the most volatility, and tech companies proved that they can still crush on the back of a market that is declining, which kind of came as a bit of a mind-blowing experience because I really thought it wouldn't be as good as it was. We need to talk about it because if you look at the year-to-date performance, we haven't fully recovered yet. I mean, Apple's down substantially, Nvidia, Google, all these stocks are still showing some signs of discounts. Yet if we go on the week, look at the recovery here. I mean, whoo, baby, Meta's up 10%, Microsoft crushed up 12%, still flat on Google. I mean, I'm still down a bit on Google. We got a bit of recovery to go there. Apple posted numbers that were astonishing, yet they're offering, guidance is a bit mixed right now. They're not offering like crazy guidance, but it's roughly soft across a lot of these companies like Apple, Amazon. But the numbers, you have to admit, were still shocking. I mean, let's just take a look at total revenue here. Basically 219 billion from 210 billion this time last year. That's on the 6 month, and on the quarter, 95 versus 90. I mean, these numbers, they're pretty great at a company this scale that is finally starting to show signs of a return to growth. And again, on the back of a terrible economy. And if we take a look, a lot of that growth is just coming from services. Huge growth in services. iPhones were up just a little bit. Macs were up a little bit. iPads were up quite nicely. Yet wearables were basically down. So overall, I mean, these earnings, is anybody really complaining? Amazon, look at Amazon's numbers here. Net product sales went from 143 billion to 155. And if you scroll all the way down and basically just look at net income from 10.4 to 17 billion. Yet they're also offering softer guidance on the back of these tariffs. So, I mean, the tariffs are offering the uncertainty, but for most companies, especially with Meta, these companies where we thought advertising dollars were going to get hit, we're still seeing a bolstering amount of revenue and still reasonable guidance. So lots to look forward to on the US side of the economy. Tech stocks, I'm really glad I sold out of SCHD in favor of tech in the S&P because, again, that's where the resilience remains super strong. And again, I think that's what's alleviating. And as I said, if earnings would be the defining factor to where the market goes next. And I'm starting to think that we found a bottom, though that's not guaranteed. Now, the next earnings are going to be on the Canadian side of the border, where similar to the US, it's a bit of a mixed bag year to date, even though the Canadian market is performing better. And on the week, we've seen quite a good recovery in a variety of stocks, mainly in the financial sector, which I'm more thankful for because the ETF that I own in Canada is upper weighted the Canadian banks, and I'd prefer to be that way because that's where the outperformance has been in the Canadian economy, though we've also seen quite a recovery in tech. However, let's broad view my portfolio. We'll talk about the stocks that I own, the ETFs. We'll get into Take-Two Interactive, which is canceling GTA 6, breaking my heart here a little bit. We'll talk about my feelings around that and so much more. So if you are on a path to financial independence, if you damn well one day want to retire early, go hit the subscribe button. If you'd like to support the channel, go to kylelivingston.com. I got one-on-ones. You can get my spreadsheets here and a bunch of investing tools, my WhatsApp group, chat with me daily, and so much more. That link's down in the description. But otherwise, looking at the portfolio, we've been holding all-time highs, not on a percentage basis, but because I shoveled so much damn money into the market when the greed and fear index hit like maximum fear, that extreme fear where we were almost at the bottoms. And, when my family and friends are calling me saying, hey, Kyle, what's up? Should we be worried? What's going on? That's when I hit buy, because it's always the best time to buy when nobody knows what the future is, and that uncertainty leads to a massive sell-off. And now we have some certainty. We're getting alleviation of that uncertainty, which has helped. So otherwise, I got a ways to go, and I'll do an update on my percentage gains when the bank updates it, because this is just my total percentage of returns based off when I bought these, which I've been buying them for over a year now, but we're up 10% overall, $35,000 gain, not that bad in a recovering market. And let's talk about it with the ETFs first and foremost. VOO is about it's recovered 13.7%. On a year to date, it's down 3.3. So we're in a nice recovery mode here. Same with the global markets that are now almost flat. If you own an ETF like XEQT, which I've only recently started accumulating, again, VDY, if you include the dividend, we are probably green on the year now, and especially from peak to trough here, you'd have to go back to November of 2024, and we're only down about 3.7%, but if you include the dividend, it's likely you're mostly flat. So I'm going to continue to buy some VDY here, and we need to see if the earnings can hold up as well as the U.S. earnings did, especially with the banks, because JP Morgan, a lot of the U.S. banks crushed, so we'll see if the Canadian banks can, even though they're trading at some pretty high multiples right now for the historical averages. Meta has been like one of the major outliers, and it's been a long time since I personally bought, or even the wife has bought Meta, because it was our single largest tech position up till the recent 34% correction, and I thought this was largely unjust. When it comes to Google and Meta, these stocks do not price in any of their AI or future expectations. You're literally just buying them for their fundamental business. And with Meta, like, they haven't even monetized WhatsApp or any of these other apps, and they proved exceptional growth. Their underlying fundamental businesses, as I told you, even if ad spending slows down, their core businesses are still growing. Users are still growing at like mid-single digits, which doesn't sound like a lot, but when you already have almost like half the world's population using one of your apps, and I mean, even still, like, look at the usage on Threads. I don't even use Threads, but they're paying people to use Threads now, and Threads is not that reasonably far behind like X anymore. I mean, all of their apps are just, this is a great, I don't know how you look at this company and shit on it by any means. So like, I had no problem picking up some shares down here because it dipped so hard, and now I'm up 10%. I think my buy was around 540. So nice to see a bit of a recovery there. And actually, I can take a look on my sheet here and just see where my average price was for Meta. Yeah, I think my 544 is where I picked them up. So I didn't catch the exact bottom, just to show you, hey, I'm not a genius. But, I'll pick the dips up where I think they're reasonable. So Meta, trading at a PE that's been about a historical average for them. When they were getting into that 30 price to earnings range, I think that was more fair value for the growth we've been experiencing. But I think now we're trading back down toward discount territory, because historically this thing tends to trade between 20 to 30, and that's kind of where we're at in the lower 20s right now, or where are we at right now? Probably 23ish. I'd still buy here, but obviously buying it closer to that 20 PE was a very chef's kiss. Now we look at Google. This is still my favorite stock. It is our single largest position right now, and it still has had a hard time recovering at an 18 PE, which after those earnings blew my mind. Again, the PE ratio, to put it in an example, trading at an 18 right now. The last time we saw a PE ratio this low was back in 2012. Keep that in mind, 2012. We have well over a decade, and Google is still, look at the earnings growth here. Look at this. This is insane. We're on one of the greatest earning growth trajectories the company's ever experienced, yet we're trading at one of the lowest price to earnings multiples. And we were joking that Google's the only stock you can buy that gets you exposure to SpaceX. They do have a sizable position in SpaceX. They have genomic editing in the healthcare space. I mean, self-driving, you name it, none of that is priced into the stock right now. All that is free. There is no growth stock out there where you can buy all that stuff for free. And get an underlying business that continues to grow it by leaps and bounds, and a comparable business, YouTube, that trades for a tenth of the discount, in my opinion, compared to what Netflix trade for, even though their revenues are considerably the same. I'm always astonished by Google, and I might even buy a bit more. I think we're getting a bit leveraged here because the wife does own quite a bit. My position sizing is at about 25K. What's my average on this right now? I think Google, I own roughly 113 shares, average price of 174, and the price today obviously still below that. So we still got some room to go before I'm break even. I'd have to do a comparable with what the wife holds to see where we're at. We might actually be closer to this with what the wife holds, because I think she got a better deal on it than my average buy, because we were buying for quite a while, I think into the end of last year. So we'll definitely see what Google does, but I'm happy holding here any day of the week. Now, finally, Take-Two Interactive. This stock I'm split on right now, because I didn't want to hold it for longer than a year. I was really expecting the hype, and we saw some of that hype come in because of GTA 6. I'm speculating that it's largely underanticipated what GTA 6 is going to do for this company. It'll be the greatest piece of media ever released, and it's likely going to add 3 to 5 billion in earnings, which would give this probably about a 10 times multiple today. But that is not going to happen this year. So the stock tanked miserably because we saw the news release today that they're delaying it. Of course they're delaying it. It's already been over 10 years. Why not wait another year? So they're planning on releasing it in May of next year, which I've kind of got mixed feelings about, because I feel like in a time where people are tired of tariffs, there's no good games out, it would be a really good time to release the game to give people an escape from reality, in a sense. And yeah, clearly investors weren't happy. It dropped 6%, though we are starting to see a little bit of a recovery here. It is getting bought up on the dip. And I think the reason that it might be getting bought brought up on the dip is because the pipeline they have this year is still quite strong, and they're not changing their guidance on the current pipeline. And luckily, I don't think they even added GTA 6 into the current guidance for this year. And I'll kind of read the headline because I'm sure many saw, the reiterated headlines that GTA 6 wipes out, on game delay here. But I'll read you the actual, quote from the CEO here is, we support fully Rockstar Games taking additional time to realize their creative vision on Grand Theft Auto 6, which promises to be groundbreaking blockbuster entertainment experience that exceeds audience expectations. While we take the movement of our titles seriously and appreciate the vast and deep global anticipation of GTA 6, we remain steadfast in our commitment to excellence as we continue to release a phenomenal pipeline. We expect to deliver multi-year period of growth in our business and enhance value for our shareholders. And I like that he said that multi-year growth because they're still expecting this year to be quite strong. So I would have expected GTA or Take-Two Interactive to drop significantly more on this news. But I guess, the real virtue here is being as patient as possible, and just I'm going to have to ride this out longer than I expected because I still want to be a part of this stock when that game comes out. So it's still holding quite strong at 220. We're still up pretty significantly because I was buying toward here at all-time highs. So my average buy price I think is around 211, 212 or whatever. So I'm just going to have to sit, be patient. If you're in this stock for that reason, you're going to have to be and hope that the earnings to come are continually strong because that'll support the price here. But otherwise, yeah, I'm still giddy. I'm still excited for the game release. But hey, it is what it is. It's the joys of being an investor. And sometimes patience is the end game. As Warren Buffett says, money always transfers from the impatient to the patient. So we'll see if that actually pays off. Overall, I'm still excited and hoping that I can reach 400K here relatively soon. That's been the end game. I've been fighting desperately, throwing a lot of money in here. We sit at all-time highs, and many of my friends have similar mindsets to investing, and they were investing quite aggressively toward the bottoms as well, and their portfolio is now toward all-time highs because, again, if you were buying those bottoms, guys, or buying anywhere in here, I mean, you've seen anywhere from a 10 to 13% gain. So congrats to those bull investors that are steadfast in their mission, and in their strategy. So stay cool, stay awesome, and let me know what you think in that comment section below.